In this video, we're going to talk in more detail about gross domestic product, commonly referred to as GDP, and how this important piece of economic data can cause some wild swings in the financial markets. Now, as we have briefly touched on in a previous lesson, GDP is the broadest overall benchmark of economic activity and quantifies the production of goods and services within a given country. It's arguably one of the most important economic statistics, and it is calculated by adding up all expenditures on all final goods and services produced during the year, using the following formula. GDP equals household consumption, like rent, food and fuel, plus investment, plus total government spending, plus net exports, which is exports minus imports. As higher net exports are more economically productive, simply put, an increase in GDP tends to indicate an improving economy, which in turn is genuinely positive for the domestic currency. On the contrary, any decrease in GDP relative to the previous quarter, or indeed the same period in the previous year, is generally negative for the domestic currency. Now, I say generally here because it's not as straightforward or as simple as positive or negative readings. It's important to know that an extreme economic expansion can ramp up inflation expectations and even create significant inflationary concerns. Now, most, if not all, central banks have a mandate to keep inflation in check, which means any signs that an economy is overheating might inspire or increase the chances of a central bank cutting interest rates and tightening monetary policy. Most of the components that comprise the report are known well in advance, meaning that GDP tends to be well anticipated. However, that doesn't necessarily mean that trading opportunities are not there. If the figure differs from the market expectations, it has the potential to cause some significant market movement. There are several leading indicators for GDP, including PMI, business inventories, retail sales, and housing data. Now, the Purchasing Managers' Index, or PMI, is released by the Institute for Supply Management on the first business day of each and every month. The report itself collects better, same, or worse information from a total of 400 purchasing managers throughout the country and then compiles it into one index. But why is the report significant? Well, simply because manufacturing activity is an important segment of any economy. This is because an increase in manufacturing output can actually suggest more demand for consumer goods, and since workers are normally required to actually produce these goods, an increase can help to boost employment and also employee wages. Now, always look at the inventory levels, as sometimes the goods produced do not make it all the way to the consumer, sometimes often sitting in storage until the demand picks up. Rising retail sales in conjunction with rising manufacturing output can also indicate heightened demand for consumer goods. An increase in inventory can suggest that businesses are building a surplus of inventory based on consumer demand expectations. Now, if higher consumption materialises, then this will be both good and profitable for the business and therefore good for the economy. But on the flip side, holding inventories costs money in storage costs, and high inventory levels can actually sometimes indicate that supply does actually exceed demand. Now, this can often be a sign that retail sales are inadequate and that consumer confidence is muted, a negative signal for the business and, of course, the economy. Retail sales are released on a monthly basis by the US Department of Commerce on a Thursday, generally 2 weeks after the end of the previous month. The data is utilised by many government sectors to calculate GDP and inflation, as well as analyse present economic activity. Strong retail sales will in general directly increase GDP. Improving sales for a company means profitability, and the company can potentially hire more employees. So in all, it's good news for the domestic economy and, of course, its currency. As I mentioned, housing data is also an important factor of GDP. Building permits give insight into future real estate supplies. High volume would indicate an active construction industry, which in turn brings more jobs and an increase in GDP. But bear in mind, like inventory levels, if consumers are not willing to buy, there will be a surplus of housing, which will likely lead to a decline in house prices. Now, declines in housing have a negative impact on the economy for several reasons. Firstly, they decrease homeowner wealth. Secondly, they reduce the number of construction jobs needed to build new homes, which in turn will increase unemployment. They will also reduce property taxes, which limits government resources, and homeowners are less able to refinance or sell their homes, which may force them into foreclosure. Now, when you look at housing data, you should be looking at two things. Firstly, changes in housing values, and secondly, changes in sales. When sales decline, it generally indicates the values will also drop. For example, the collapse of the US housing bubble in 2007 had dire effects on the economy, and is widely blamed for driving the US economy into recession. There's an old saying, when the US sneezes, the whole world catches a cold. Now, this basically emphasises that US data figures such as GDP or central bank policy are so important both domestically and globally speaking. The health of any economy is intimately connected to consumer sentiment, but the health of the world's biggest economy, the US, is important to global sentiment. However, when all is said and done, it is sentiment what drives the markets.